Once again, Sean Johnny. Thank you for tuning in. On today's video, we're going to be talking about how to use credit cards and how they work. Let's get into it. Alright, on today's video, we're going to be talking about credit cards. And you guys must be wondering why I have so many. And I'll tell you why I have so many credit cards. I have a total of around 12 credit cards. And you must be like, whoa, Sean, why does somebody need that many credit cards? And to be honest, nobody needs that many credit cards. I just have that many credit cards. So the reason why I have so many credit cards is because of all the benefits credit cards offer. I'm able to get points for free travel, free meals, free gas, free cash back. Ultimately, using credit cards responsibly is much better than using a debit card. I attempt to never use my debit card. If they don't accept, I never ever use my debit card. The reason why I never use my debit card is because I'm leaving free money on the table. For example, I have an Apple credit card, and every time I use my Apple credit card, I get 1 to 3% cash back on my purchases, depending on the purchase. So I could pay you can either pay with your debit card 100% of that purchase, or for me, I'll pay from 99% to 97% of that purchase. And that may not seem like, whoa, Sean, okay, you're only getting 3%. That may not seem huge, but over time, if you put all your living expenses, your phone bill, your home expenses, if you put as many expenses that you already put on your debit card, that already hits your bank account, if you put those all on a credit card, you save massive amounts of money. Each year, you're able to take free trips, get free airfare. But before you can do all that, you first got to understand what are the factors in your credit score. So let's start there. So there's 5 factors into your credit score. The first one is payment history, and that is how often or how many times have you made your payment on time, or how many times have you missed a payment. So say you've had a credit card for 100 months. How many times of those 100 months have you missed a payment? And a payment isn't considered late until it's 30 days past due. So with my credit score, I have never had a late payment history. I make my payments, even if it was the minimum payment, I make all my payments on time. I now, as an adult, I pay all my credit cards, the full statement balance, and I wipe it off clearly. I do not get charged interest. I could say before I was younger, before I fully understood the power and how to master credit cards, I did struggle to pay off my credit card balance. So you must understand yourself as a person, and you also have to understand your financial situation of how much credit can I realistically use each month and how much can I realistically pay. And this is why you should always create a budget. Number 2 is your credit utilization. So basically what that means is out of how much credit you have. So for example, say you have $10,000 of available credit. If you take available credit and you divide it by credit used, you get your utilization. So if I have $10,000 that I could pull out, and I use $3,000 of it, I'm using 30% of my credit utilization. And for your credit score to increase, you want to keep it below 30% each month. Once you get over 30%, you'll see your credit score start to plummet. If you get into the high 90% of your credit score, typically the credit bureau is like, oh, what's going on? I think he's strapped for cash. That's why he's using so much credit. So you always want to use this utilization below 30%. I recommend below 10%, so you're always able to pay off everything that you have for credit. Third is your credit history length. And so this makes up 15% of your score. I apologize, your credit utilization makes up 30% of your score, and your payment history makes up a 35% of your score. So your credit history length, again, makes up 15% of your score. And this is basically how long have you had credit. And this is where you have to be cognizant of when you apply for new credit cards, that every time you apply for a new credit card, you shorten your your credit history length. So maybe you had your first credit card when you were in college, and now it's been 4 years, but throughout that time, if you have applied for 3-4 credit cards, they're gonna take the average of those cards and say your credit history length is 1.5 years, even though you've had credit for say 4 or 5 years. They take all your credit, your old and your new. So rule of thumb is never, ever, 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 even if you don't use it anymore, cancel your oldest credit card. So if you have one from back in high school, back in college, maybe one that your parents opened up for you, do not cancel. I know even if you don't use it, do not cancel it, because it negatively affects your credit, and there's no point of canceling something that you're not using because you're not getting charged interest. Eventually, the banks are just gonna cancel your card, which might take a couple of years, but that is fine. You will not get a hit on your credit for them canceling it, for not using it, but you will get canceled for you canceling it, or you will lose credit for you canceling it. Sorry. Number 4, your credit mix. So this is a 10% of your score, and this is kind of when a credit bureau pulls your credit score, they want to see that you have a thick file. You know, some people have perfect payment histories, but they have a very thin file because they don't have a lot of different credits, and they like to see you have multiple different types of credits. For example, for me, I have credit cards, I have student loans, I have a home mortgage, I have a car loan, and that I'm able to pay all those payments without any issue. And so it makes me have a thick credit file. They're like, okay, this guy can have multiple different types of credit, and he's able to master and understand how to use all of them and has no issue paying them down. Ultimately, you want to pay as much as all those as possible. This one is 5, is just new credit. And this makes up another 10% of your score, or we call this hard inquiries or soft inquiries. So there's certain type of credit cards that will either pull in home mortgages, car loans, anybody that's pulling your credit, they may either do a hard pull or a soft pull. And so the difference between a soft pull and a hard pull is a soft pull doesn't show up on your credit, while a hard pull does, and it drops your credit score about 1 to 2%. Which is fine, it's gonna bounce back, so don't be worried about if you get a home mortgage, a car loan, or a credit card. Oh, I don't want to get my credit docked because, I was looking for credit. That is fine, as long as you're not looking for tons of new credit. Applying to 5 or 6 different credit cards a day, 3 or 4 mortgages every single month, that will negatively impact your credit score. But if you're looking for new credit, say every 3 to 6 months, and you're buying a new home, or you're looking to buy a new investment property every 6 to 9 months, the new credit will not dramatically affect your credit score. So these are the 5 ways that affect your credit score. Thank you guys for watching this video. Please hit the link in the description. I have a lot of great tips. I have a lot of links down there for how to start investing, open up a brokerage account, get started on M1 Finance, get a free $10, get started on Robinhood, get 1 free stock, get started on WeBull, and get 3 free stocks. Again, there's tons of links, so please click the link in the description. Also follow me on Instagram, Twitter. Have a great day. Bye.